Hello there, I'm your host Leela Rao, welcoming you to your fortnightly program Invest Wisely, your ultimate gateway to safe and intelligent investing. Today's topics for discussion revolve around high net worth investors with specific focus on estate planning. With this in mind, coming up in this session, important things to consider on estate planning. Comprehensive financial planning is not complete for the high net worth investors or private clients without intelligent estate planning. For sure, as an investor, you can depend on your qualified investment manager to execute this. But on your own, you have some responsibilities, and knowing the important do's and don'ts about estate planning will help you in having an efficient plan in place. Following that, how to mitigate the estate taxes. Estate taxes are sometimes referred to as voluntary taxes in the United States. This is mainly because there are several ways to avoid paying taxes where they are subject to. Carefully planning the transfer of wealth to your spouse or children is a very essential part of estate planning. This will minimize or totally avoid estate taxes so that your near and dear ones are left with a lot more. And finally, in question time, we will discuss some interesting emails by viewers. Important things to consider on estate planning. Estate planning, in simple words, is making plans for transfer of your estate upon your death. Sounds so simple when you hear it, and if planned well, it can be the simplest and easy solution in practice as well for your beneficiaries. Wealth transfer is a dynamic process and should not be put off by anyone, especially the high net worth, thinking they will plan it when they get a little older. Start considering about estate planning even while you are building your wealth. Now let's go over some important items you need to consider when it comes to estate planning. The first and foremost thing that comes to my mind is have a will in place. A will happens to be the most important component of any estate plan. In a will, you need to clearly indicate the time, names of beneficiaries, and the determined share of each beneficiary. You also nominate a guardian should you have minor children and should something happen to you or your spouse. The will being a very important document, its wording is extremely crucial. Don't forget to update your will if any major changes occur in your life or the lives of your beneficiaries. The second item to consider is forming a living trust. This is especially important for the high net worth and the ultra high net worth. Forming a trust helps prevent your heirs from going through probate. This is how it works. The person whom you appoint as the trustee simply transfers ownership to the beneficiaries of the trust you formed. This makes the process less time consuming and avoids payment of any legal or court expenses. As soon as the property or the estate has been transferred to your heirs or beneficiaries, the living trust does not exist anymore. Thirdly, have a healthcare power of attorney in place. Here, another individual, which in most cases tends to be the spouse, or if not, any other trusted family member or friend, to make important healthcare decisions on your behalf. Make sure the person you choose would know your mindset and act exactly as you would prefer. Fourthly, have a durable power of attorney drafted, and if you are a married couple, it is most advisable to set up reciprocal powers of attorney. The person you name in the durable power of attorney acts on your behalf. He or she may have the power to transact financial assets such as real estate on your behalf. This kind of power of attorney is, however, revocable when the principal becomes fit again or mentally stable or upon his or her death. The fifth point of importance in estate planning is to designate beneficiaries. Retirement plans such as 401k or IRA, insurance plans, your bank account pass on to your heirs even without a will in place. This is the most important reason why you must name a beneficiary and a contingent beneficiary as well. If you fail to nominate a beneficiary or if the beneficiary is deceased, the court could decide as to who benefits out of your funds. The decision may not be in tune with what you would prefer, and hence the need of such an exercise. Sixthly, have a letter of intent in place. This would especially come in handy if for some reason your will becomes invalid. The letter of intent describes to your executor or beneficiary as to how you would require a particular asset to be handled after your death or incapacitation. The letter of intent also helps a probate judge in making suitable decisions when needed. Seventhly, keep enough liquid assets to satisfy estate taxes. This could be in the form of cash or cash equivalents such as stocks or bonds. IRS usually allows up to 9 months' time from the death of the principal for payment of any federal taxes, and this must be done in cash. A life insurance policy comes in very handy to satisfy this tax liability. Talking about life insurance, we come to our 8th point. Buy and hold the life insurance in a trust. If owned by a trust or third party, life insurance proceeds may be income tax free to the recipient and not subject to estate tax. The 9th point I wish to bring to your attention is relevant to business owners. If you are a business owner, make sure you have made arrangements for orderly transfer of assets. This can be established by proper legal agreements. Last but not the least, create a list of all your financial accounts. Where appropriate, make copies and also let the related parties know where you keep the documents. When we come back, I shall discuss with you some strategies to mitigate estate taxes. Stay tuned. Invest Wisely will be right back after a short commercial break. Welcome back. I'm Leela Rao, your host for Invest Wisely, your ultimate gateway to safe and prudent investing. In 1789, Benjamin Franklin, in a letter to Jean-Baptiste Leroy, said, "In this world, nothing can be said to be certain except death and taxes." Estate taxes are certain as well, but can be avoided if planned well ahead and properly. Wealth transfer frightens some people thinking they would run out of resources during their lifetime. A qualified portfolio manager would use core and excess capital strategy with the help of quantitative analysis. Core capital is calculated to make sure you have plenty of resources to maintain your lifestyle till the end. At the same time, excess capital is calculated to see how much can be transferred to your heirs from time to time, making use of all the tax advantages available while you are still alive. Before we delve into the estate tax saving strategies, let's get some tax law facts straight. The IRS tax code says, for estates of decedents dying in 2010, the executor may elect out of the estate tax by filing a Form 1839. Note, year 2010 had no specific dollar limit on the assets that could be left to your heirs. Well, this tax holiday was a mammoth bonus for the high and ultra high net worth to be able to hand over a lion's share of their assets to their cherished ones, which was otherwise impossible in the past unless they left their estate to charity. Ironically, is it possible for all wealthy donors to choose their year of death? Unfortunately not, but it is possible to choose tax-efficient strategies to reduce or completely eliminate estate taxes by employing proper and qualified professionals. Common tax sheltering strategies are trusts, insurance contracts, limited partnerships, and foundations. These strategies are not merely tax savings tools, but also provide benefits related to asset control and protection from creditors. In all these strategies, you must understand that taxes are only levied on the assets of decedent he or she directly owned, and the taxman cannot lay hands on the assets retained in a well-designed trust. The first of the strategy that we shall look into is setting up a credit shelter trust. It is particularly advantageous in the case of couples. Estate plans could be set in such a way that the assets are divided into two separate trusts, a surviving spouse trust and a credit shelter trust. At the death of the first spouse, the benefits of the assets held in the credit shelter trust are still available to the surviving spouse, though the assets are not actually owned by the surviving spouse. Hence, the surviving spouse is able to maintain the same standard of living while the first spouse was alive. Now, with the demise of the surviving spouse, the assets of both the trusts are passed on to their heirs. This being the details on how the assets are transferred, what is the tax advantage here? Though the surviving spouse was able to enjoy the benefits of the assets in the credit shelter trust, the assets are not taxed as part of the second spouse's estate. As per the current exemption of $3.5 million per donor, the parents could pass on $7 million free of federal estate taxes. Life insurance is the second of the estate tax sheltering strategy. When you create a trust, the principal dissociates himself from the assets by transferring them to an assigned trustee for the advantage of the beneficiaries. This creates a possible advantage as to how the assets are controlled, protected, and taxed. Life insurance can be looked upon as a similar tool in which the policyholder transfers assets in the form of premium. In return, he receives a contractual obligation to pay death benefits proceeds to the beneficiary that is named in the policy. Akin to trusts, life insurance provides both tax and estate planning benefits. Irrevocable trust is the third strategy that could be used for tax advantage. When couples or families have assets in excess of estate tax limits, they should set an irrevocable trust. This is how it works. Under the existing tax laws, a person can gift up to $13,000 in one calendar year to the same person. For example, you and your spouse could each gift $13,000 to your child or grandchild, the gift totaling to $26,000 per annum. If you are not willing to give up control of the wealth, you could place these gifts in a trust with named beneficiaries. The donor spouse will still control the trust. Thus, parents or grandparents can shelter $26,000 per child each year from any potential estate taxes even while they are still alive. If you purchase a life insurance using the funds gifted to the irrevocable trust, you will be further reinforcing it. The last of the strategy I wish to discuss is especially relevant to ultra-high net worth families. This is setting up family limited partnerships. Larger estates often require intricate planning with respect to succession strategy for adequate protection of the management of family businesses or property. Setting up a family limited partnership not only provides estate tax relief but also helps in putting into practice a proper succession plan. Let me explain this. Property or business owner could make detailed legal provisions for the management of assets after his or her death. Allocation of profits or organizational hierarchy could be detailed. Tax exposure can be minimized using such limited partnerships by devaluing the estate from a tax point of view. Restrictions could be created on the usage of certain elements of the property like land or limit the owner's ability to sell or transfer the property. Such restrictions would decrease the appraised taxable value of the property, thereby saving on estate taxes. Before wrapping up this portion of today's session, I wish to say a few words on estate planning for individuals and families having assets in more than one country. Estate planning is to be executed here in the global context, and taxation is to be considered with respect to the home country and also the countries where the principal has assets. Double taxation conflicts can be resolved either through foreign tax credit provisions of the home country or relevant taxation treaties with other countries. This may be of particular relevance to immigrants in the Indian or any other South Asian community with assets in the form of real estate or business interests in their home country and also in the United States. As a wealth manager servicing clients from different countries, I can tell you that estate planning in the global context is all the more complex and requires careful consideration of several aspects to plan intelligent transfer of wealth transfer across generations. I will discuss on this at length in one of the future episodes of Invest Wisely. Coming up next is question time. Stay tuned. Invest Wisely will be right back after the break. Welcome back. I'm Leela Rao, your host for Invest Wisely, your ultimate gateway to safe and prudent investing. I have a question from Dr. Kapoor in Minnesota. She asks, I'm watching Invest Wisely regularly. Thank you for your informative program. I have a question for you. Could you explain what is generation skipping transfer and how high net worth individuals can benefit out of this? Thank you, Dr. Kapoor. Generation skipping transfer is the transfer of property by way of gift or devolving upon death to a person who is two or more succeeding generations than that of the person who is making the gift. The gifter is the transferor and the recipient is called the skip person, who is actually the beneficiary of the trust. In a family scenario, normally a grandparent would choose a grandchild as a skip person. But in reality, according to the IRS, the skip person need not be a family member. Anyone other than the spouse or ex-spouse is permitted to receive a generation skipping transfer as long as they are 37.5 years younger than the transferor. In fact, according to the IRS, a relationship by adoption is considered a blood relationship. A relationship by half-blood is considered a relationship by whole blood. As for the benefits to the high net worth, the skip person will have to pay tax only if he or she receives amount in excess of the GST estate tax credit. The GST estate tax credit has been $2 million per person since 2006, and this high tax credit allows several skip persons to escape the clutches of the GST tax. I have another question from Mr. Sharma in New York. He says, I'm 65 years of age and a successful business owner. I'm considerably well off to be categorized as high net worth. I plan to retire soon so that I can spend more time with my grandkids and also travel around with my wife. I do have a retirement portfolio, and my friends have suggested I buy an annuity to have a steady stream of income throughout my life to support my standard of living. I wish to enjoy the earnings from my investments and also leave my children and grandchildren as much as possible. Would you support my buying an annuity with my investment holdings? Thanks for the question, Mr. Sharma. I hope you have an estate plan in place and are also investing with a qualified portfolio manager if you wish to leave as much as possible for your heirs. I see that you want to bequeath your wealth without sacrificing your lifestyle during your lifetime. Since you wish to travel widely with your wife and spend time with your grandkids, I gather that you are in good health. In this scenario, buying an immediate annuity is not a very good idea. I would suggest that you look into a longevity annuity, which would require probably an allocation only up to 10 to 15% of your assets, as opposed to an immediate annuity, which would demand 60% or more. A longevity annuity would start the payout in 5 to 20 years, depending upon the terms you choose. I'm sure you could invest your portfolio more wisely to grow your assets and also reap some income for your living needs in the meantime, rather than annuitizing a huge portion of your assets and leave less than half of what you would want for your dear and near ones. Watch out for more interesting topics for the benefit of high net worth investors in Invest Wisely. We welcome you to write with your questions and comments to leelarao@goodwinasset.com or investwisely@tvasiausa.com. Alternately, visit the following address shown on the screen to be directed to a question form. I'm Leela Rao, signing off for today. Until we meet again, remember, do not feel rich earning money, but invest wisely to be truly wealthy. Thank you.